Hi, everyone. Welcome back to English Podcast Voice. I'm Quinn.
And I'm Riley.
Today, we are embarking on a deep dive into a topic that, to be honest, sometimes feels like trying to read a legal document in a completely foreign language.
Oh, I know the feeling.
Financial vocabulary. I was looking through all this source material, bank brochures, credit card agreements, and it's just packed with confusing jargon, like which account actually gives the best rates, or how do you avoid those weird hidden charges and fees that just pop up out of nowhere.
Right.
It genuinely feels like the bank speaks a language that's designed to make you feel overwhelmed.
You are definitely not alone in that. Financial English is, I think, one of the densest dialects we have, even for native speakers.
Okay, good. It's not just me.
Not at all. But understanding this specific terminology is incredibly high utility. It's not just about, passing a test. It's about making better financial decisions that can actually save you hundreds, if not thousands of dollars. So our goal today is to cut through all that confusion. We are using the foundational banking, loan, and credit documents you found to really zero in on the core terms that every B1 English learner needs to master.
That's our mission then. A shortcut to being well-informed, targeted straight at the words that matter the most.
Absolutely. And we're going to clarify some key strategies, like how you can sometimes ask the bank to waive a fee.
Oh, that's a good one.
And we'll tackle that crucial idiom about saving money for a rainy day. And definitely stick with us until the very end.
Oh, a teaser.
Because we're going to surprise you with a fact about the most common vocabulary mistake made when discussing your salary. The difference between gross pay and net pay. It catches everyone out. And we'll test your understanding in our pop quiz later.
Okay, I am ready to absorb this knowledge and maybe finally understand my bank statement.
Let's do it.
But first, a quick note. Please make sure you subscribe to English Podcast Voice right now and give this episode a quick like. It truly helps us reach more learners and continue delivering these detailed deep dives.
Let's jump right in and start managing some money.
Okay, so where do we start?
We begin with the absolute basics. Why do we even trust banks? The source material opens with a really fun historical note reminding us that, people didn't always use them.
Right. They used to hide their money under the mattress.
Under mattresses, in shoe boxes, or even, and this was my favorite detail, in their freezers.
The freezer method sounds a little risky. I could just picture finding a frosty $20 bill years later.
Right. The point is, while that sounds kind of cozy, modern banks and credit unions exist to offer far greater safety, convenience, and functionality than a sock drawer.
I would hope so.
They're formalized institutions that allow us to manage our funds efficiently and, crucially, keep them secure. They're also backed by things like FDIC insurance, which ensures that even if the bank fails, your money is protected up to a certain limit.
That safety net is key. It basically replaces the mattress.
Exactly. And the foundation of all banking is just movement, getting money in and getting money out. So we need to lock in those core action verbs first.
In simple terms, it's either putting money in or taking money out.
Perfect. So if you are taking money out maybe from an ATM or transferring it from savings to checking, the verb is to withdraw. The noun is a withdrawal.
A withdrawal.
For instance, that check register for Maria Lopez showed an ATM withdrawal she made on February 10th. This is money moving out.
And the opposite, like if my employer sends my salary directly to my account, or if I put cash into the bank machine.
That is to deposit the money, and the transaction is a deposit. Most people today get their pay via direct deposit, which just means the money goes automatically into the account.
Okay, deposit and withdraw. Got it.
Now, speaking of depositing, if you receive a paper check, you often need to cash it.
I've noticed a difference here. The source material mentioned that cashing a check at your own bank is usually free. But if you go to one of those commercial check cashing businesses, they charge a pretty big fee.
That's a really practical nugget of knowledge right there. Commercial check cashing services exist for people who might not have traditional bank accounts, but they charge a hefty premium, sometimes 3 to 5% of the check's value, just for that instant cash.
Wow, that's a lot.
It is. So you should always use your own bank or credit union to avoid those charges if you possibly can.
A smart savings tip built right into the vocabulary lesson. I like it.
Let's also quickly review borrowing versus lending. These verbs often trip up learners. Think about that example of Yoko, who needed money for her car insurance, and her uncle stepped in.
Okay, so Yoko is the one receiving the money, and her uncle is giving it to her temporarily.
Correct. Her uncle loans her the money. He is the lender. Yoko borrows the money from him. She is the borrower.
Got it. Lender gives, borrower gets.
And she then has to pay back or repay the loan, usually in installments. In Yoko's specific case, the source notes her uncle was very generous and wouldn't charge her any interest, which is a fee for borrowing the money.
A friendly, interest-free loan.
Exactly. But in the formal banking world, interest is the cost of borrowing.
Okay, so wait, I keep seeing this word waive when banks talk about fees. It feels very formal, but it's clearly really important. What does it mean for the bank to waive a fee, and why is this word so important to know?
That's our first essential term, and it's a huge one. To waive means to officially give up a claim, a charge, or a right. It means the bank or institution is intentionally deciding that you do not have to pay something that they otherwise could legally charge you for.
So if they waive a fee, they're basically hitting a temporary cancellation button just for me.
That's a perfect way to visualize it. It's a formal decision to cancel a charge. And strategically, knowing this word allows you to negotiate because banks often waive fees if you meet certain criteria.
Why would they do that?
Well, they're often willing to give up a small fee to keep a profitable customer happy.
Oh, okay.
Let's run through a few examples to show its range. A formal one. The university usually charges a $75 application fee. But if the student applies online before the priority deadline, they have decided to waive that application fee entirely.
Okay, that's a nice incentive.
A more casual example. I called my cable company and complained about a service outage, and to apologize, the representative instantly decided to waive the late payment penalty from last month.
I should try that.
And a really relevant one. Many banks impose an annual credit card fee, but if you spend more than, say, $20,000 on the card in a single year, the company will automatically waive the yearly charge as a reward.
I really like that last example. It links the act of waiving directly to a benefit for meeting a requirement. Let's try a scenario role play. I'll be a customer who thinks they were unfairly charged.
And I'll be the bank representative ready to look up your account details. Go for it.
Hello, I see a $12 monthly service fee on my statement. My account agreement clearly states that if I set up direct deposit, that fee should be waived. Can you check that for me?
I understand your frustration. Let me just look. Yes. I see your direct deposit was initiated last week. The system hadn't updated yet. I sincerely apologize. I am processing a credit now to waive the $12 fee, and I've ensured the system will recognize the condition going forward.
Perfect. It's great to know that if you understand the rules, you can sometimes get the bank to waive those fees.
Absolutely. And just to solidify this, notice the words it often partners with, the collocations. You most commonly waive a fee, waive a requirement, or waive charges.
Got it.
Now, let's move from canceling fees to avoiding them entirely. Your checking account is your engine for everyday transactions, but as you noted, they often come with a cost. Monthly service fees, maybe $5 to $15.
Why do they even charge those fees? Is it just for the convenience?
Partially, but mainly it's to encourage profitable behavior. See, banks make money when they hold large balances, so they offer ways to waive that monthly service fee.
Ah, there's that word again.
Right, and the two most common conditions are meeting the direct deposit requirement, which is great for the bank because they know where your money is going, or maintaining a certain balance.
That brings us to our second essential term, the one they always seem to emphasize in the fine print. Okay, so the minimum balance. I know minimum means the smallest, but what is the balance referring to in this context, and why is that specific number so powerful?
Good question. The balance is simply the total amount of money currently in your account. The minimum balance, therefore, is the lowest amount of money that must remain in your account without dropping below it to satisfy the bank's requirement.
So if you dip below that threshold.
Exactly. If you dip below it, the bank can impose penalties, usually that service fee we just talked about, or they might stop you from earning interest.
So the minimum balance isn't just a number. It's like an invisible line that separates me from paying extra fees.
Precisely. For the bank, it's a way of segmenting customers. If you can maintain a higher minimum balance, they often reward you with better accounts, higher interest, or, fewer fees.
That makes sense.
Let's explore 3 ways this phrase pops up. A formal example. This premium savings account provides a 4% interest rate, but that benefit is contingent upon the client strictly maintaining a minimum balance of $2,500 throughout the entire quarter.
Okay. Pretty
It's
strict?
a casual one. Before I approved the purchase for the new bicycle, I quickly checked my banking app to make sure I was still safely above the $300 minimum balance required to avoid the monthly fee.
I do that all the time.
And a strategic example, many small businesses choose to use a credit union over a large commercial bank because the credit union's required minimum balance to access free business checking is often significantly lower.
That's a great tip.
Yeah.
It's all about incentives. If the bank is going to keep your money, they want a consistent minimum level.
Absolutely. Let's try a quick skit where the minimum balance causes some real-world concern.
I just paid my rent. My account balance looks scarily low.
You need to be careful. If your checking account balance drops below the $750 minimum balance on file, they will hit you with a maintenance fee, and you know they won't waive that easily next time.
You're right. I need to hold off on those online purchases until I deposit my next paycheck. That minimum is acting like a brake on my spending.
Perfect. And the common collocations here are to keep or maintain a minimum balance, and the painful outcome is when your account drops below the minimum balance.
So we've handled money in and out.
Yeah.
And the whole concept of account minimums. Now let's talk paper checks. The source material spends some time on the crucial final step before using a check you receive.
Yes, once you receive a check made out to you, you can't just shove it into the ATM. There's a crucial legal step required, which uses our next target verb, endorse.
What does it mean to endorse a check? Is it really just signing my name, or does the word carry more weight than that?
It carries significant legal weight. To endorse a check means to sign your name and usually your account information on the back of the check or legal document. This action authorizes the transfer of funds.
So it's not just a signature.
No, it's the legal mechanism by which you signal to the bank, yes, I am the rightful recipient and I authorize you to put this money into my account. Without a proper endorsement, the check is legally worthless to the bank.
So endorsement is the moment of authorization. It's much more than just a signature.
Much more. Think of it as certifying the transaction. If you don't endorse it and the check gets lost, anyone could potentially try to claim those funds. That's why mobile banking apps now insist you write for mobile deposit only below your signature.
I've seen that.
Let's see how this word is used in different settings.
Yeah.
A formal example. The document required the CEO and the CFO to formally endorse the new financial regulations before they could be filed with the government.
Okay, very official.
A casual one. I completely forgot to endorse the paycheck this morning before I sent my spouse to deposit it, and the teller made her sign it right there in the lobby.
That sounds familiar.
And a legal example. If a check is made out to a business, only an authorized person who has the power to endorse documents on behalf of the company can legally sign the back of that check for deposit.
That solidifies it. It's about authority and transfer. Let's try a skit about the modern digital process, because that's often where people get confused about how to sign paper for a screen.
Perfect. I'm your confused friend trying to use the new mobile app feature. Okay, I have the app open, and the picture of the front looks great, but the app is telling me to take a picture of the back. Why?
You need to flip it over and endorse the check first. Sign your name on the designated line.
But it's going into the app. Why do I need to sign a physical check if I'm never giving the bank the actual piece of paper?
Because the bank still needs proof that you, the payee, legally authorized the electronic transfer. They typically want you to write for mobile deposit only and your account number right below your signature to fully endorse it for the app.
Ah, that step makes sense. Now I know how to properly endorse a check for digital banking.
Easy.
Excellent. The primary collocations here are, of course, to endorse a check, but you can also endorse a legal document or sign on the endorsement signature line.
Got it.
Beyond individual transactions, we really must stress the operational side of account keeping. The source material strongly emphasizes using a check register.
A check register.
Yeah, it's a manual record book where you track every check you write and every deposit you make, separate from the bank's records.
That sounds incredibly old-fashioned. I mean, doesn't my bank app or online statement do this automatically for me?
They do, but this manual step is crucial for financial literacy and for security.
Oh.
Once a month, the source material instructs you to perform a process called reconciliation.
Reconciliation.
This means comparing your manual records in your check register with the bank's official bank statement.
Okay, but why should I bother if I trust my bank?
Because banks and automated systems are not perfect, and neither are we. Reconciling helps you in 3 critical ways. First, it confirms your account balance is truly what you think it is.
Okay.
Second, it allows you to track outstanding checks ones you wrote but that haven't been cashed yet. And third, and this is the most important, it helps you spot fraud or errors instantly.
I had thought about that.
Remember Maria Lopez's transactions. If she records a $973 deposit on January 19th and the bank statement shows $793, she knows immediately there's a mistake she must investigate. Reconciling prevents small errors from becoming huge problems.
That's actually a really good point.
Now let's pivot sharply from daily spending to future planning, specifically specialized savings accounts. This section involves understanding the key trade-off. Higher return often means higher risk or restricted access.
Give me the high utility breakdown of these specialized tools. What do I really need to know?
Okay, first up, certificates of deposit, or CDs. These accounts require you to keep your money completely locked away for a fixed term. It could be 6 months, 3 years, or 5 years.
Locked away. Okay.
The advantage is a guaranteed, often higher interest rate than a standard savings account.
The word locked sounds pretty restrictive. What happens if I need that cash before the term ends?
That's the strategic risk. The major disadvantage is the steep penalty fee for early withdrawal. It's called a liquidity risk. The money is not liquid or easily accessible.
So you could lose money.
The penalty can sometimes negate all the interest you've earned. People use CDs specifically for money they absolutely won't need for the duration of the term, like a college fund starting in 4 years. It's forced saving, which is psychologically effective.
Okay, so a CD is for a very specific goal.
Exactly. Next, we have individual retirement accounts, or IRAs. These are explicitly for saving for retirement. Their massive benefit is the tax deferral or tax-free growth they offer.
Which means
You pay less tax now, or you pay no tax on the growth later, depending on the type of IRA you choose.
tax benefits sound amazing. What's the catch here?
The penalty is tied to your age. The source material is very clear on this. You cannot typically touch the funds without a severe financial penalty until you are 59 and a half years old.
59 and a half. Wow.
You're essentially making a contract with the government that this money is for your very distant future. If you withdraw it early, you usually pay both income tax and a 10% penalty fee.
Wow. So IRAs are absolutely not for a down payment on a house or next summer's vacation.
Yeah.
The penalty is just too severe.
Precisely. They are long-term specialized tools, not emergency funds.
Okay, what's the third one?
Our third option is money market accounts, or MMAs. These are often offered by brokerages or investment firms, and they appeal to people with large cash reserves because they require a high minimum balance.
How high are we talking?
Often $5,000 or $10,000, much higher than a checking account minimum.
And if I can meet that high minimum, what's the reward?
The interest rate is usually higher than standard savings, but critically, that interest is based on the current market rate, which means it fluctuates.
Oh, so it goes up and down.
Right. When the market is doing well, the return is great. When the market is struggling, your interest rate drops.
What's the hidden risk compared to a standard bank account?
This is the key detail from the source that a lot of people miss. Depending on where the MMA is held and how it's structured, it may not be insured by the FDIC in the same way a standard checking or savings account is.
Wait, really?
Yeah. If the institution faces financial distress, your principal, the money you deposited, could be at risk. This is why you must always read the fine print regarding insurance when you're opening an MMA.
That distinction is incredibly valuable. Knowing that money market accounts carry that specific insurance risk changes how you approach them entirely.
Moving into the necessity of borrowing. Most people need loans for big life expenses. Car loans, student loans, and of course, home loans, which are known as a mortgage.
When I hear the word loan, I immediately think of interest and debt, and figuring out the best deal is always so complicated.
It is, and the source material provided an excellent case study with Samuel and Miranda Reyes comparing car loan options. It really illustrates the universal truth about borrowing money.
They were financing $8,000, and the bank offered them 3 different loans: 36 months, 48 months, and 60 months.
Right. Let's analyze this deeply. Loan C was the longest, 60 months, and it had the most attractive feature for a tight budget. The lowest monthly payment of just $163.
That sounds pretty good.
But here is the financial trap. The total interest paid over those 5 years was $1,790.
But wait, if I'm an intermediate learner and I need my budget to stretch, that $163 payment is a lot easier than the $249 payment of the 36-month loan. Isn't a longer loan worth the extra total interest if it helps me survive month to month?
That's a fantastic strategic question, and it reflects real-world decision-making. Yes, the low monthly payment offers essential short-term relief, which is often necessary.
Right.
However, strategically, you have to understand the cost. The shorter 36-month loan, Loan A, costs $249 per month, which is tough, but the total interest paid was only $959.
So the longer loan C costs nearly double in total interest, $831 more, just for the flexibility of lower monthly payments.
Exactly. This demonstrates the core principle of amortization. When you take out a long loan, the bank is front-loading the interest. In the early years of that 60-month loan, nearly all of your $163 payment is going toward interest, not reducing the principal.
The principal being the original $8,000 they borrowed.
Correct. A longer term means you pay interest on the remaining principal for a longer time, exponentially increasing the total cost.
So a lower monthly payment always equals a higher total cost in the end. That's a crucial takeaway.
It is. And we shouldn't forget the role of the down payment. Samuel and Miranda put a substantial amount of money down up front. The down payment is the initial cash you pay to the seller.
Which helps how?
Paying a down payment reduces the principal you need to borrow, which instantly lowers your interest costs regardless of the loan term. It reduces your debt burden immediately.
Good to know.
Now, when you apply for any of these loans, the bank has to decide if you are worth the risk.
And that takes us to our next key term. When the bank assessed the Reyes family, they looked at their credit risk. I know this means financial danger, but how do banks precisely calculate this? And what can I do to make sure I'm not seen as a high risk?
Great question. Credit risk is the probability, as calculated by the lender, that a person will default, meaning they will not pay back the loan or will pay it back late. It's purely a measure of reliability.
So they look at your past behavior.
They do, by looking at your credit report, which we'll get to in a minute.
So if I have excellent financial habits, I always pay on time, I'm a low risk.
That makes you highly creditworthy, which means the bank trusts you. A low credit risk gets the best interest rates, like the lowest APRs. A person with a high credit risk will either be denied the loan entirely, or they'll be charged significantly higher interest to cover the bank's potential loss.
So your credit risk is directly linked to how much money you spend over the life of a loan.
Exactly. Let's look at 3 examples that define this risk spectrum. A formal one. Due to a history of multiple late credit card payments and high current debt, the applicant was identified as a high credit risk, resulting in a mortgage offer with an interest rate 2% higher than the market standard.
Ouch, 2% is a lot.
A casual example. Because she has maintained the same credit card for 15 years and always pays her balance in full, she poses an extremely low credit risk and can qualify for the lowest rates available.
That's the goal.
And a comparative example. When a new business with no financial history applies for a loan, they inherently carry a moderate credit risk because they have no established record of repayment, even if their business plan is solid.
The connection to the interest rate is what makes this term so critical. Being a low risk saves you real money.
For sure.
Let's try that bank manager scenario again. I'll be the frustrated applicant needing a car loan.
Okay, I'm ready.
Manager, I'm trying to get a loan for a car, but the interest rate you offered me is 9%. My friend got 4%. Why is mine so high?
I understand the rate difference is frustrating, but we have to assess your credit risk. Your report shows you've utilized nearly 95% of your available credit limits on your credit cards, and you have 2 recent collection notices. That signals a high credit risk to the bank.
So what's the strategic move to lower that risk?
You need to significantly pay down your current debts to improve your utilization ratio, demonstrate 6 months of reliable, timely payments, and minimize new borrowing. As your credit history improves, your credit risk decreases, and we can offer you a much better rate.
That puts the power back in my hands. And the common collocations here are to be a high-low credit risk, to assess credit risk, and, crucially, to take steps to minimize credit risk.
Exactly. And to become that low credit risk, you need a good credit history. The source materials detail 3 main paths to establish this history.
This is the practical advice we need.
First, through credit cards. Using them responsibly is key. If you're just starting out, a secured credit card, where you give the bank a cash deposit up front, is a safe way to build credit without the bank taking on much risk.
And then you can get a regular one later.
Right, you can graduate to an unsecured card. The second path is successfully repaying structured loans, like a student loan or a small personal loan over time. Consistency matters more than the size of the loan.
Okay.
And the third path is increasingly recognized, non-traditional records. If you don't have credit cards, the source notes you can sometimes use proof of a steady work history or reliable records of paying utility bills or rent on time.
Oh, that's interesting.
These show a lender that even without a formal credit product, you are a reliable payer.
It's encouraging that they look beyond just credit cards.
It is. Speaking of credit cards, let's quickly nail down 4 specialized terms related to using them. First, APR.
That's the annual percentage rate, right? The yearly interest.
Correct. The APR determines how much it costs to hold a balance. The source noted that certain activities, like a cash advance, which is getting cash using your credit card, often have an APR that skyrockets, sometimes to nearly 30%. You really want to avoid those.
Definitely. And the credit limit.
The credit limit is the maximum amount of money the card issuer allows you to spend. This is critical for your credit score. Lenders monitor your credit utilization ratio, how much of your available limit you are using.
And you want to keep that low.
Right. To be a low credit risk, you want to keep that ratio low, ideally under 30%. If your limit is $1,000, try not to spend more than $300.
Got it. And what about the grace period?
The grace period is a window of time, usually 25 to 30 days, between the end of your billing cycle and your payment due date. If you pay your entire balance in full before the grace period ends, you pay 0 interest on those purchases. So that's the trick.
It's why many financially savvy people use credit cards for convenience but pay them off fully every month. They're effectively borrowing money for free.
That strategy is fantastic. Pay within the grace period and avoid the APR entirely.
Finally, let's talk about checking your credit report. This is the document detailing your borrowing history. It is so crucial because the source material indicates that you should check it regularly, especially if you get turned down for credit.
Why is that so important?
Because errors happen. Mistakes on your report could mistakenly label you as a high credit risk.
So checking your report is not just good practice, it's like a defense mechanism against potentially costly mistakes.
Precisely. Now let's address the entire purpose of all this financial organization, saving for what life throws at you.
Okay.
Which brings us to a great idiom.
What exactly does the idiom "put by for a rainy day" mean? I have to admit, when I first heard it, I thought it meant saving money specifically for a new umbrella. Thankfully, it has nothing to do with meteorology. This is our most common and, I think, most beloved financial idiom. To put by for a rainy day means to save money specifically for future unforeseen difficulties, emergencies, or unexpected hard times.
It's your safety net.
Exactly. A sudden need for an emergency car repair or a job loss. Those are classic examples of the rainy day.
I see.
The Reyes family source material explicitly states the importance of having money available for rainy days or unexpected expenses, preventing a crisis from forcing them into high-interest debt.
How much should you save?
Well, strategically, financial experts recommend you save 3 to 6 months' worth of living expenses put by for a rainy day.
Okay, that's a good goal.
Let's illustrate the idiom with 3 distinct scenarios. A formal one. Financial advisors strongly recommend that clients automatically set aside a small percentage of their monthly income to put by for a rainy day, creating a liquid emergency fund.
Makes sense.
A casual one. I loved that jacket, but it was expensive. I decided to skip the purchase and put the cash by for a rainy day instead of spending money on something I don't truly need right now.
That requires some discipline.
It does. And a planning example. After paying off their car loan, the couple decided to continue depositing the old monthly payment amount into a high-yield savings account, purposefully putting the money by for a rainy day instead of just increasing their lifestyle spending.
That illustrates the discipline required. You have to consciously choose to save, even when you want to spend. Let's try a quick skit where the rainy day fund saves the day.
Sounds good.
Oh my goodness, Riley, I just got a massive vet bill for my cat. It's over $800, and I was not expecting it this month. I don't know how I'm going to pay for this.
That is terrible news, but remember, you've been so good about putting money by for a rainy day. That emergency savings account you started 6 months ago should cover this unexpected cost completely.
Oh, you're right. Thank goodness I resisted buying that new gaming console last month. That rainy day fund is saving me from going into credit card debt right now.
Perfect. That money was saved precisely for that unexpected difficulty. The key collocations here involve the saving action, to save for a rainy day, to have money for a rainy day, or to stash away for a rainy day.
Got it. Stash it away.
We've covered a ton of high-utility vocabulary today, but now it's time to tackle the one common financial error that confuses intermediate learners and even some native speakers.
The big one.
Confusing gross pay and net pay.
Okay, I really need this correction. Let me try to state the common mistake. So I know my take-home pay, the money I actually get in my bank account, is, say, $1,600. I thought gross pay was just the base salary, and net pay might include things like bonuses, meaning they could be close in size, or maybe gross could even be smaller sometimes. Is that close to the misunderstanding?
That is a very common, very nuanced misunderstanding, but it's still fundamentally incorrect, and it's so important to clarify. Let's return to Samuel Reyes's budget numbers to make the distinction crystal clear.
Okay.
Gross pay is the absolute starting figure. It is the large amount of money you earn before the government takes its share, which is taxes, and before any other deductions like health insurance premiums are taken out.
So it's the full unreduced income.
Exactly. It is the big number on the top of the pay stub.
Right.
Once the employer subtracts all those deductions and taxes, all those legally required costs, the amount that remains, the smaller figure that you actually receive in your bank account, is your net pay.
Also called your take-home pay.
Exactly.
So gross is the starting total, and net is the final amount. Gross is always, without exception, larger than net.
Always. If you see two figures on a pay stub, a native speaker knows instantly that the larger amount is the gross pay, and the smaller remaining amount is the net pay.
That's a simple rule to remember.
In the Reyes example, Samuel grosses about $1,400 a month. But after all the deductions are applied, his net pay, the money he can actually use, is only $1,200. That difference is significant for budgeting. Never confuse the two, or you risk thinking you have more money than you actually do.
That is an absolute necessity for budgeting and understanding my salary. I will never forget that gross is greater than net.
Fantastic work. We've hit the end of our deep dive, so let's test the retention of our listeners with a quick 3-question pop quiz based entirely on the vocabulary we dissected today.
I'm ready. Let's do it.
Question 1. You met the conditions of your new bank account, and they told you they would officially cancel the $10 monthly service charge. What is the verb used to describe the bank intentionally giving up this fee?
They decided to waive the fee.
Correct. To waive means to officially give up a claim or charge. Question 2. If you have successfully paid back several small loans and kept your credit card utilization low, the bank is likely to classify you as having what type of risk?
They would classify me as a low credit risk.
Spot on. That means they trust your ability to repay debt. And question 3. What idiom is used to describe money saved specifically for an unforeseen emergency, like a sudden medical expense or urgent home repair?
That money is put by for a rainy day.
Excellent work. You have mastered those core terms.
I feel more confident already.
So what does this massive flow of information mean for you, the learner? If you integrate 3 critical terms into your English financial conversations right away, remember these.
Number 1, waive. Knowing this word gives you negotiation power. You can ask for fees to be canceled if you meet the requirements, like maintaining that minimum balance.
Number 2, endorse. This is your authorization step. You now understand that you must sign and include specific information on the back of a check to legally approve the transfer of funds.
And number 3, credit risk. You know this directly impacts your financial life. It determines whether you get a loan and the interest rate you pay. Understanding how to minimize that risk saves you real money in the long run.
Now, for your micro challenge. We want you to internalize this new language immediately. Your task today is to write down one strategic goal using one of these phrases. For example, I will maintain a high minimum balance to ensure my fees are waived.
Oh, I like that.
Think strategically about your own finances and use the language we covered.
And as always, don't forget to like this episode and subscribe to English Podcast Voice for your next deep dive. We love being your study buddies on this journey.
Until next time, keep that knowledge flowing and keep that credit risk low.
I'm Quinn. See you next time.
And I'm Riley. Bye.